This presentation is meant to show the actual data of a multi-million-dollar a year net profit debt collection business, with an initial investment of only $500,000. This is for anyone interested in purchasing debt as an investment vehicle or anyone just looking to better understand the business and numbers. I'll be showing some financial data in the presentation. This will help the viewer understand the concept of debt buying and collecting. If after watching this, you have any questions or you need an explanation for a word or definition, I invite you to contact me. I'd be happy to provide more in-depth explanation, and you can find my contact details in the description. Let's start with the definition. Like any debt instrument, home loans, corporate bonds, municipal bonds, consumer debt can be sold or transferred from the issuer to another entity. For our purposes, we're usually talking about delinquent or charged-off consumer loans and lines of credit. Examples of this range from credit cards to auto loans, student loans to doctor bills. A debt buyer is a business that purchases these debt obligations from the bank or issuer. They buy them in bulk. We call these files portfolios, or just call them files. We use both interchangeably. In our case, we outsource the process of liquidating the receivables to a collection agency, but in many instances, a buyer may deploy an in-house process to monetize these assets. First, I'd like to give you a little background on the industry. Debt buying, within the context that we're discussing here, grew out of the American savings and loan crisis of the 1980s. After the FDIC assumed the assets of these failing institutions, the S&Ls liquidated the assets through auctions or to investors. These assets, meaning loans, as in savings and loans, were effectively what sparked our quasi-boutique industry. Today, the industry is made up of investors, collection agencies, law firms, as well as vendors who provide software, data, or other related services. When most people think of collections, they think of a collection agency collecting on behalf of major credit grantors, such as Wells Fargo or US Bank. But when we talk about debt buying, we're talking about purchasing those assets. We purchase the rights and assignments to them and thus take ownership of the accounts. We in no way represent the credit issuer in the way that a collection agency would represent a client on a contingency fee basis. For anyone who has a mortgage, this should sound familiar. After your loan was originated, it was sold to another institution, and then another institution, maybe a time or two more over the years following that origination. This provides several benefits to the issuer. For one, it allows the credit grantor to distance itself from the collection process and maintain a better public image as they continue to market and offer new financial products or extend credit for other products or services. It also allows the issuer to monetize these receivables immediately, keeping with the time value of money concept. Consumer debt has enduring value. In manufacturing, you have research and development, then fabrication, and hopefully several sales over time. With consumer debt, the revenue stream generally begins within the first days of collection management and then produces cash flows over the next several months or even years. One of the key benefits of this high-velocity cash flow is the buyer's ability to reinvest net revenues into additional inventory and repeat the process over and over again. Portfolios can be partially liquidated and then sold, partially liquidated again, resold, and so on. You've got to remember that while consumers may fall on hard times, they typically recover. After a buyer has realized their liquidation targets for a purchased portfolio, it can be resold on the secondary market to bring more value. Only a small portion of the entire portfolio needs to be liquidated to hit the buyer's targets. That's what we're going to talk about next. As you can see in the pie chart here, as much as 45% of the receivables we purchase will never even locate the consumer. This is a simple fact of modern society. People move, they change phone numbers, and for various reasons, they're difficult to contact. 18% of the ones we can contact will never return a call, never answer their phones, or respond to legally required written notices. 10% of people will have a genuine hardship that makes repayment impossible, and 7% of our file will file for bankruptcy. So you can see at the bottom of the chart that only about 15% of the accounts purchased are actually collectible during the time that we own them, and that's absolutely okay. A buyer's pricing takes this into account. Projected collections over a particular period are how we determine the price we pay on a file. The following is one example of how a performance projection might look. For a $500,000 investment, keep in mind, there are dozens of ways a buyer could organize this: internal versus external management, rate of reinvestment, chosen debt class, etc. You'll see that as monthly cash flows come in, we quickly turn around and reinvest in more inventory. A specific rate of reinvestment has been applied to these calculations to balance our OI with risk. Each deal is structured differently, so a careful discussion of risk aversion should be had to meet the objectives of each particular buyer. Also, a specific budget for expenses has been applied to the cost of management. This is separate from the fees paid to collection agencies. Typically, a customized set of expenses and liabilities should be prepared for higher outcomes. But in this case, to keep the math simple, I just applied a flat percentage, which is more than we would ever pay. You can also research for a list of general caveats and warnings applicable to this kind of investment. For this presentation, we're using a portfolio with an aggregate outstanding balance totaling $5 million. As I mentioned earlier, we are using $500,000 as what we paid to buy the file, with a purchase price of 10 cents on the dollar. In reality, we would pay $250,000 to $350,000. But we want to keep the math simple for demonstration purposes. You can see the first month's total gross collections on this file is $98,000. In the second month, it is $146,000, and on down the line, you can see the cash flows are robust at the beginning and then drop off over time. We pay the agency fees and internal management expenses. For this example, we've applied a 30% contingency fee for the agencies who work the file. We usually pay 22%. We've also calculated a flat 10% management budget. However, we always work on a percentage basis. Let's review the figures we've got so far. In order to get the accounts to liquidate, we've outsourced them to a collection agency. In reality, we'd probably outsource to a couple of different agencies depending on the size of our file, but for this, we're just doing one. After the agency takes their fee, we're left with $68.3 thousand. At the end of the month, we'll call that gross revenue, and we'll talk in terms of gross and net revenue from here on out since those are the numbers that most matter for this presentation. You can think of this in the same way you might think of gross versus net income. After management fees, we're left with $61,475 in net revenue. That looks pretty good so far, right? So let's go back and talk about gross revenue for a minute. Here's a chart showing the first year's gross revenue. Look at gross revenue for file number 1, again robust in the beginning with a sharp drop-off and a dwindling rate of recoveries over time. Remember that the first month's gross revenue became $61,000. After we net out our management costs, we'll call that cost to collect. So what can we do with that $61,000? Well, if we took our $61,000, went into the market, and bought the same kind of file at the same price, our $61,000 would fetch an additional file with a face value of $614,750. That's in addition to the one we bought before with a face value of $5 million. That's a great idea, but just to present a different option, we're going to take a different path. Here's a cash flow analysis for the first 12 months. We'll go over this in detail, so there's no need to memorize it now. You can see the gross revenue coming in, management fee being netted out, and the net revenues then being $61,000 just as before. We have a decision to make here: distribute the funds to the buyer or investor, or reinvest into more inventory to collect on. In this presentation, we've chosen to reinvest 95% of our net revenue and distribute the other 5%. Keep in mind that all these figures are movable and can be adjusted to reflect the goals of the specific investors and managers. In this presentation, the 5% is going to go to the investor. This is about equal to the amount that would be earned on the money market fund, but it could be used to pay broker fees or whatever is agreed upon between the managers and investors. More importantly, though, we have $58,402 in net revenue to spend on additional inventory of charged-off receivables. If bought at the same rate as the first file, this would get a file with a face value of $584,000. So in the second month, we'd have our agency simultaneously collecting on the first file and beginning work on the second file. You can see that reflected in the figure here. In the second month, there are 2 files being collected on, which yields a total gross revenue of $110,000. This continues month after month for the first year. Each month, we add a new file. Each file begins with robust results and subsides after a few months. You can see here how aggregate gross revenue, net revenue, and reinvestment amounts grow each month as a result of the rate of reinvestment. In the first year, we end up with a total gross revenue of about $2 million. $1.7 million of that is reinvested into additional inventory, and just about $90,000 is returned to the investor. Year 2 operates in exactly the same way as year 1. We keep growing the portfolio by reinvesting 95% of net revenue. You'll notice that we have a total gross revenue of $3.6 million, reinvest about $3 million, and distribute $163,000 to the investor. Remember, this is all done only with the initial investment of $500,000. We'll go through the next couple of years applying the same math. Feel free to pause or slow down the video to take a closer look if you'd like. By the end of year 3, we make our investor whole and keep distributing that revenue share every month thereafter. In the 5th year, we're going to take a different course. We are going cash out the entire operation. We are going to stop reinvesting in new inventory entirely, but we're going to leave the owned assets under management. To date, we've spent just shy of $20 million on inventory, so using the same math as before, we've ostensibly purchased assets with a face value of about $200 million. Remember, we did this with only $500,000 to start. No more money was put in. Back to year 5. Here, we've amassed a large pool of assets that are now under management. We're going to distribute all net revenue and discontinue purchasing new inventory. Over the course of the first year of doing this, we distribute $5.8 million in revenue share, as well as an additional $16.7 million in total dividends. Not bad for a $500,000 investment. As we discussed before, these assets have an enduring value. What you don't see in this projection is that if left alone, this portfolio will continue to generate monthly dividends for another 3 to 5 years, albeit at a rapidly diminishing pace. Alternatively, we could look to sell the entire portfolio or monetize those assets sooner rather than later. We'd be doing this in much the same way that the issuers did when they sold us the accounts in the first place. The options and opportunities are really as vast as the creativity of the managers involved. Then we start over and do it again.